Hello, I'm Jared Nelson, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. The market is behaving strangely these days. The inflation trend is uprising, but the signal coming from the bond market is this: don't worry. I suppose bond investors aren't worried because there's a big buyer in the background, the Federal Reserve. The U.S. Central Bank is committed to buying $80 billion worth of treasuries per month, plus $40 billion in mortgage bonds, and this suppresses the yield curve. In this week's show, we would like to show you three charts to start a discussion on the macro picture. The first chart is lumber. This commodity is special because it is widely used in the construction business and is sensitive to growth expectations. Earlier this year, lumber spearheaded the commodity to the upside on the reflation trade, and prices doubled in a few short weeks. But trends like these seldom last. Unsurprisingly, prices have corrected sharply to the point that lumber is now reporting negative year-to-date returns. So this begs the question, have growth expectations dialed down? More worryingly, could lumber's complete reversal be a harbinger for other commodities? Base metals, food, and energy prices have all experienced sharp gains this year. If speculative money pulls out, the entire commodity market will be very vulnerable. Some commodity-related stocks are already under growing pressure, such as copper stocks. The next chart concerns the small-cap Russell 2000 index. We saw that the Dow, Nasdaq, and S&P all climbed to fresh highs recently, but not the small-cap index. Take a look at the $65 billion Russell 2000 ETF. Its chart suggests a stalled uptrend, toppy as some may call it. Prices have not really advanced in 2021, and we wonder why. In a roaring bull market, traders typically buy the riskiest instruments like small and micro caps because the upside potential is bigger. We certainly saw a lot of these activities in GameStop earlier this year. This bout of speculative fever has receded somewhat over the past couple of months. Many small-cap stocks have corrected significantly from their 2021 highs. This means a large number of traders, if they are still in these stocks, are bag holding. Will this contraction in speculative sentiment spread to the larger cap stocks? It is possible. If the economic situation deteriorates, investors may be forced to sell part of their most profitable positions, currently in the large caps. The third chart we are showing today is the dollar index. Over the last few months, the talk on the street is that the dollar is poised to go down the drain. There are just too many dollars sloshing around in the system, they say. Look at the Fed's balance sheet. Just recently, Jeffrey Gundlach of DoubleLine said the dollar is doomed over the long term because of the country's deficit. However, a reality check on the dollar's chart shows something else. It is behaving contrary to these bearish expectations. In fact, the price of the dollar has remained remarkably steady this year. The dollar index ended last week at 92.5, a level no lower than a year ago. If the index rallies from here, it would generate a pattern known as the base breakout, a bullish formation. One reason fueling the dollar's strength is that other countries are not doing particularly well. Pound sterling, for example, has weakened recently because of the sharp rise in COVID cases there. The country is reporting 50,000 new cases per day. Likewise, Europe and Japan are also battling another wave of pandemic, and in many parts of Asia the pandemic is still raging. Therefore, the spring optimism has faded significantly. Holidays abroad are problematic. International trade remains hampered. A historic Ghost Olympics in Japan is underway. In last week's show, we talked about the pros and cons for hedging one's stock portfolio, simply because we anticipate some market weakness in the second half of the year. This week, we highlight some other macro trends that have moved in the opposite direction of the bullish market consensus, quietly and under the radar of most investors. We suspect the market could be approaching an inflection point where many prior trends may reverse significantly, especially on crowded trades like tech, ESG, crypto, etc. Of course, the market is an evolving mechanism and nothing is set in stone. The fickle market sentiment can reverse quickly, flip-flop, or simply prolong into autumn. That's all we have time for this week. Make sure you do your own due diligence before making any investment decisions.